morning, and I think it's time for us to go back home to the Ukraine. So what I would like to do for the next 10, 15 minutes is talk about what's happening in the banking sector here. And the way I will do it is I will be using a lot of statistics that we're seeing in the system and also in the markets, and then talking about numbers as well as issues associated with those numbers. So let's begin and take a look at what happened last year, and then we're going to move forward to where we are now and what we think we can expect for the next 18 months, perhaps until at least the presidential elections in March 2015. Okay, now I have a lot of data, but I think sometimes it's good to talk about numbers because we make conclusions from these and we can see some very clear trends. So first, as you all know, last year the GDP growth in the country was registered at 0.2%. It was a lot less than anyone expected, and as a matter of fact, the last 3 quarters, it was actually an economic recession in Ukraine. So it's a very, very a large stagnation in the economy, and certainly something Ukraine doesn't need for a country that needs to still be growing and making massive investments in infrastructure and supporting the export industries. A 0.2% economic growth certainly is not a very good statistic and doesn't help much. When we look at some of the factors behind that from a banking sector perspective, 2 of the things you look at immediately first are what were the growth in deposits in the system and what were the growth of loans in the system. And what you'll notice is that it was better in 2002 compared to 2011, and what you're noticing is that there was a relatively balanced growth in deposits both on local currency and on foreign currency. LCY is local currency, FCY is foreign currency. But what is interesting is that there was a very big divergence in what was happening between the corporate sector in terms of deposits and in the retail sector. So the people on the street were putting more money in the banks, which is good in a way because it shows that there was more confidence in the banks. To see a 13% growth in retail deposits is actually good, but what is not so interesting and worrisome is that corporate deposits were less. And when you have corporate deposit growth at negative, that obviously has a very direct impact on banks being able to fund themselves, because many, many banks only fund themselves with corporate deposits or external deposits, and that therefore affects loan growth as well. So what we've seen is on the loan growth side, it was actually negative for the whole country. And a few things you can pull out of that are that, one, if you have negative loan growth, the immediate conclusion you can make is that the banking sector is certainly not contributing much to economic growth, because economic growth is driven in large part by loan growth. If banks are not lending more money, that means that companies are not borrowing to make more investments or to perhaps refinance themselves to make themselves more efficient. So that statistic is something that we watch very carefully, and frankly, last year it was quite worrisome. And another thing that you can pick out of that is retail loan growth was depressed, and that means that banks are lending less to retail. They're still pulling out of the retail sector or reducing their activity. Looking at the big picture, you've probably seen these numbers, but it's always good to restate this just so we know where we are. We have 175 banks with banking licenses in the Ukraine. All of you in the audience must be thinking, well, gee, that's way too much. We don't really need 175 banks. And the truth of the matter is that about 90% of all the banking activity in the country is roughly 30 or 40 banks. So that's really the scope of what's really happening in the Ukrainian banking sector. 30 to 40 banks are doing virtually all of the economic work, you might say. So we have 53 banks with some amount of foreign capital, 21 banks under liquidation. And one thing that I do want to point out on the second part of this slide, and this is important, is that last year was the first year since the crisis where the banking sector cumulatively made profit. And that's very important because we all do understand that the banking sector in Ukraine is still quite fragile, but the fact that last year the total sector, which is all the banks together, made a net profit of 4.9 billion, that isn't that impressive on a net profit level, but at least it's positive and it represents an improvement from 2011. Also, a few other improvements that we saw in the banking sector last year in Ukraine were that the very worrisome net long U.S. dollar position has decreased, and that's a big risk in an environment where devaluation is always looming over us. For banks to not have the right foreign exchange position would be very worrisome. So that's reduced. And also the share of FX loans in the Ukrainian banking system has also reduced considerably compared to, say, 2009 when it was as high as 48, 49%. And I've just shown you Kazakhstan and Russia. It's still much lower. It gives you an idea that Ukraine still, as a percentage of of loan assets, the share of foreign exchange assets is still too high. Again, a residual effect from the overly enthusiastic foreign exchange lending that we saw in Ukraine before the crisis. So what are the issues that we can sort of deem from some of the statistics that I showed you and some of the other things that we look at? Well, first, the deposit base of banks in the system, other than the largest banks, is still relatively weak, and there's an over-concentration in deposits. So that needs to be gradually improved over time to decrease the fragility of the banking system. Second, the corporate deposit growth is still more or less shrinking. It's not growing very fast at all, and that is a core determinant and driver of overall lending activity to the corporate sector in Ukraine. And if you're not lending much to the corporate sector, you're not having much investment, you're not creating jobs, you're not supporting exports as much as you should be. It's all interrelated. Third, we all experienced last year what we would call the effects of muddling through. You know, a key government policy was to protect the exchange rate. It was probably the most important policy that affected the banking system last year, and it was implemented in two ways. One was in the beginning of last year, the government used a lot of its precious FX reserves to support the currency, and then toward the second half of the year, it used liquidity, basically reducing, choking local currency liquidity in the system, again to protect the exchange rate. Both of these effects created a reduced economic growth potential in the country, and also just basically resulted in why you see 0.2% GDP growth. So these effects of this muddling through economy were basically, yes, we can continue to protect the FX rate, which is our prime goal, using these tools. This muddling through, it worked last year, but at a significant cost to overall economic growth. And going back to what Taras said, is that many banks, particularly the foreign banks who are operating in the country, are still deleveraging. They're still looking at more efficiency. There is a real strong drive on return on equity or return on assets, these efficiency ratios. And when you think about it, Ukraine is a very risky country when you look at the international ratings, and banks now correlate the risk of loans they make, the risk of the country they operate, the risk of the country where their capital is, and they make a conclusion that, well, what is my return on equity on a risk-adjusted basis? And if Ukraine is considered relatively high risk compared to other countries in the region, and of course it is, then banks decide that they might need to deleverage or reshape their portfolio more, as Taras mentioned, in order to get that higher ROE. Just one other thing about 2012, a lot of you are bankers, and therefore I thought you would be interested in this. What was going on in the international markets? I was just talking to you about the local markets. Well, basically in 2012, in the Eurobond market, there were 5 deals, $5.5 billion, but the thing that you really need to see is that it was just the government of Ukraine. No one else, not one corporate last year issued a Eurobond. And the reason is because the market was not very receptive to that. And the other reason, probably less so, is that there wasn't really much need by Ukrainian corporates to issue. The level of investment was quite low. And usually when you're issuing a Eurobond, it's because you either A, have a very large new investment plan, or you're refinancing your existing debt for more efficiency. But nothing happened. And that is a massive drop from 2011 when there were many more deals. I don't show 2011, but believe me, it was down about 70%. And on syndicated loans, also down about 70% from 2011. 6 deals, $1.6 billion of syndicated funds raised for a GDP of $160 billion. That's less than 2% of the GDP, a very small amount. So last year there was very, very little international financial activity in Ukraine, a big drop from the previous year. Now 2013, some improvement so far on the Eurobonds. You know about that. The market was back. There was a search for yield. There was a large boost in liquidity. And Ukrainian issuers, including the government, did quite well. And you can see that up to now, there's been 12 deals. So that's a big improvement over 2012. But in syndicated loans now, I'm not sure. I may have missed one. But as far as I researched, there were none so far. So again, the corporate sector is still what I would say rather subdued. Okay, let's take a look at what's happening now. Okay, GDP growth, it's not very pretty here. If you talk to IFC or EBRD or the rating agencies, virtually everyone is saying it's going to be somewhere between 0 to 1%. I don't think it'll be over 1%. There could be a risk it's below 0%, but this is basically what we're hearing. Loan growth for the first 5 months of the year it's been positive, but not much so. A little more in the corporate sector, probably because of increased liquidity and the fact that there was just really no lending at all in the last 2 quarters of last year when the liquidity was really, really choked. So there's a little pickup, but I wouldn't call it that much. Retail basically flat. Deposits are up somewhat, but what's interesting is that the deposits are local currency, but on foreign currency not, which is interesting because, as you've also noticed, since the beginning of this year, there's been a somewhat unexpected stability and calmness in the FX rate. And that means if the people on the street, if clients, corporate clients are not so worried about FX rate, they're putting more of their money in local currency deposits. They're more comfortable doing that. So we're seeing that in that statistic. And we're also noticing that banking sector profitability for the first quarter is doing better than last year. So that confirms the trend that the banking sector is still heading in the right direction, which is what we want to see. So a few things that we can derive from what we're seeing this year is one, you know that there's been, Erste Bank is now leaving, so that's the 4th significant foreign bank that's left in the last few years. I think that's probably going to continue that trend, due again to this reshaping of portfolios, this overwhelming need to be re-examining your return on equity, your return on assets, your business profitability, given what you deem are the opportunities and the risk of operating in Ukraine. This trend is continuing. So what we're looking at is we're asking ourselves, well, you know, if foreign banks keep lending or reshaping their portfolio and deleveraging, are local banks really picking up the slack? And I think at this point in time, it's probably safe to say not fully. And therefore, the net effect is still the overall banking sector is deleveraging. The increase or the activity of local banks isn't fully making up for the decrease in foreign bank activity. I mentioned in the second point about our return on assets, return on equity. You're seeing that. That's not just for Ukraine, it's all around the world. We don't really think that there's going to be much of a change in this situation to the, it's not February, but it's March 2015 presidential elections. The reason why is that if the muddling through strategy continues, and I believe it will, then all of the key factors associated with that strategy are more or less expected to continue as well for the next 12 to 18 months. So basically, monetary policy drives loan growth. Monetary policy right now is a lot more friendly than it was in the last 2 quarters of last year. So we do expect some loan growth coming. The international capital markets have picked up a bit, but what's happened in the last few weeks is a different change in feeling, and we're going to have to see what the second half of the year brings. It may not be exactly the same as what we saw from January to April. Loan to deposit ratio, another key indicator, is also still falling. It's decreased quite a bit, and it was as high as 230% below the crisis, before the crisis. So basically, you want to see this ratio higher, not lower. Again, it's another indicator of the slowing deleveraging of the banking sector in Ukraine. One thing that is positive, in addition to the profitability trend, and they're interrelated, is that the share of non-performing loans in the economy, in the banking sector, is decreasing. That's good because there were way too many non-performing loans post-crisis. That's gradually being worked through, but the level is still very high compared to banking sectors in other countries. But at least the trend is moving in the right direction. So what can we expect next, in the next 18 months perhaps, based on what we've seen, what we've just talked about? Is first, I would think that the banking sector, at least immediately, is not going to be acting as the key driver to bring us out of economic stagnation. It's just not doing that. It's actually reflecting in many degrees the economic stagnation. So I don't see the banking sector growth or what's happening in the banking sector as the key driver to bring us out of the current low growth that we have. Second, what I also would propose to you for your consideration is that the banking systemic deleveraging is continuing. Foreign banks are continuing to either reduce or restructure their level of investment and activity in the country. We don't see that trend probably changing in the next 12 to 18 months. Third, all again interlinked, the fragility of the banking system will continue. There have been some improvements, but there's still quite a way to go. We have to watch this space very carefully. It's certainly connected to the muddling through policy vis-a-vis protecting the FX rate, and not at this point in time for the government to take any, what I would call, severe or controversial economic reforms. It just doesn't seem to us that this is in the cards for the next 12 to 18 months. And that means, therefore, will we see a new IMF program instituted? I would call it 50-50 at best. Right now, maybe there's no pressing need for an IMF program to be reinstituted. However, if the international capital markets shut down for Ukraine, or if there's any other form of external shock, or perhaps internal shock, that situation can change. But right now, this sort of fragile stability means, as far as we see it, the chances of an IMF program being agreed upon are 50-50 or perhaps even less. And finally, what doesn't help the growth of the banking sector is some of the problems that we've already seen that are fairly deep-rooted and that are going to take a lot of time to work through and fix. And that's the level of corruption and the fact that banks in general are suffering from a somewhat dysfunctional legal system which doesn't fully protect their rights vis-a-vis the loans that they make. So when you put all of these factors together, you'll notice that they're interrelated, and you will be able to tie them to the overall economic activity of the country as well as the health of the banking sector. So I will end my comments at this point and turn it back to our moderator, Stuart.
One thing that surprised me a bit was that in the run-up to your election here, you don't get government spend to make sure everybody's happy. That money isn't pumped into the economy either either through increased state salaries or projects. That doesn't happen, because that, in a run-up to an election in other countries, might be something that goes on.
Actually, I think it will happen, but since the election is still almost 18 months away, we're not going to see that yet. Obviously, what that means is that the current account deficit, which is around 8% and already very high and problematic, will be under pressure again once that spending does reoccur. Stuart, I do believe it will reoccur, but I think that there was already a bout of spending in the third, fourth quarter with the RADA elections last year, and therefore vis-a-vis the presidential elections. I certainly would expect to see it, but not yet.
Can I probe a bit on this, the 12 Eurobonds? Because that seemed to stand out. I mean, I didn't see the specifics, but it seemed to stand out from everything else you were saying. I mean, you were saying sort of down, down, doobie down in terms of the corporate environment, that that there wasn't activity, there wasn't borrowing because there wasn't investment opportunities, but there was 12 Eurobonds. So that didn't seem to square for me. What's going on there?
Good question. Actually, when you analyze this data, there's a few reasons that explain it. First of all, for some of these issuers this year, they were wanting to do this since last year, and the market just was not there for them. The market was not very receptive. And in the beginning of this year, there was a sentiment change in the market. There was more international investor interest in high yield. Ukraine represents one of the highest yield opportunities. So everyone was more open. Investors were willing to take a little less. The CDS for government of Ukraine risk also rallied from, say, 640 basis points last year to as low as, I think, 570 earlier this year. Therefore, the overall condition was good. Some names really had to go to market, so they took advantage of this opportunity. But I'll tell you, a few of those issuers had a very hard time nevertheless, because investors are getting very demanding. They're not just throwing money anywhere. So there were 12, that's good, but that does not say that everyone had an easy time. Some of these issuers, as a matter of fact, had a very hard time and ended up getting less and paying a lot more than they hoped to.
I've got a final question. In Russia we have this, we have an extremely open economy in that we're extremely exposed to commodity prices, particularly on the energy side. And obviously, I guess you guys are in terms of the metals. And as you look at the forecast for the economy here, how much is driven by your view of the Eurozone, and what is your view of the Eurozone in terms of, if the Eurozone doesn't do well, obviously we all have a problem, but how much of this flat and possibly negative outlook is driven by a pessimistic view of the Eurozone?
Well, when you look at what drives the Ukrainian economy, first, steel prices. 40% of Ukraine's exports are in the steel sector. And the prognosis for steel prices is still, and demand is still fairly low this year, so that doesn't help. Agricultural commodity prices, sugar, for example, prices have been down from highs in 2011, and that doesn't help either. The general lack of economic growth in Western Europe doesn't help, because Western Europe and Russia are obviously Ukraine's two largest trading regions. So Western Europe is actually purchasing less, and that doesn't help Ukrainian exports. And the Russian economy is slowing down as well. And of course, there's always political pressures that influence themselves on Russian-Ukrainian trade. It could be a cheese war, it could be milk, it could be one other agricultural commodity. Now steel is not the easiest topic, so that always is a risk. So when you add all of these together, they're all affecting the growth of exports, or the level of exports, and the overall economic activity in the country.
Okay, thank you. I mean, I have to say, listening to you, if you have a decline in NPLs now, it doesn't seem to me that that's necessarily, going to continue. But that's as an uninformed outsider. It feels from the way that you see the future as quite flat. That you can only really get this, if there's increased activity, you can work your way out of NPLs, but...
You're right, Stuart. I think, well, we didn't come to talk about NPLs, but believe me, that is a big topic. NPLs level dropped, which is good, but as I said before, it's still very high. And what you might infer is that, well, the worst got dealt with, or the easiest situations got resolved, and what's left is very intractable. So that's a different discussion. I won't dwell on that anymore. Thank you.
Okay, thanks, Steve. Thank you very much.